Hello, and thanks for joining us here on France 24 for the business interview. Is the financial crisis over, or is it just getting started? With sluggish growth around the world, Europe in the throes of grave crisis, overheating emerging markets, you'd be hard pushed to find reasons to be optimistic. Here to help us make sense of it all is the global head of research at one of Europe's largest banks, Société Générale, Patrick Leglon. Thank you very much indeed for joining us. Let's start with Greece. Now, Greece, we've been talking about it for months now. Now, the latest idea is a rollover plan for Greece's debt. It's being championed by France and Germany, but the ratings agencies, they don't like it. Why not?
You know, Tom, thank you very much for taking me on this show. The solution which is proposed and called rollover means virtually to save time, to give the possibility to Greece to reorganize and to put in place a proper tax reform, also to pave the way for economic rebound in the second half of the year. Then all this is, I would say, a very good solution for Greece and for also Europe. And we'll see, obviously, if it can happen or not.
Is Greece headed for a default, in your view?
You know, default is certainly overstated because we are not at this stage. Obviously, Greece has some clear issues in terms of primary deficit. These issues have to be addressed. But speaking of a default for Greece, certainly overstated.
So what needs to be done for Greece? What are the priorities for the country to really get it back on track?
Okay, the first priority is to help Greece financing over the short term. If we come back on this so-called rollover plan, it virtually applies for maturity below 4 years, and it gives the possibility to Greece to find money for the short maturity. And without being too technical, 20% of all the money which mature will be placed on what is called a zero coupon, which has virtually a present value of 60, which means that virtually it's a very, very good way to give, if I may say, some flexibility for the future. Now, what Greece needs, it's mainly two things. It's firstly to put in place a proper tax reform. We are aware, we know that in Greece, roughly 1/3 of the economy is done, if I may say, without accounting. It's impossible to have an economy which works properly without collecting taxes on one side. And on the other side, maybe they will need to have, if I may say, some support, some expertise coming from Europe, but obviously it raises some question mark in terms of sovereignty. But I'm sure that some solutions certainly will be worked and will be found on this.
And do you see that the political will is there, both internally and within the Eurozone as a whole, to help Greece to achieve those goals?
You know, on one side, obviously, we should not deny that the Greek situation is serious, but on the other side, what has been done in the last 2 years, from a European standpoint, is extremely impressive. Step by step, European politics and European governments are putting in place, I would say, the right approach, the right support to avoid, I would say, to go into a critical situation and to find solution.
But it's not just Greece. I mean, it's Portugal, there's Ireland. Where did it all go so wrong in the Eurozone, in your view?
You know, we need to take into account that each situation is very, very specific. Ireland was clearly a problem related to banks. Spain is an issue related to the property market. Greece is a problem of economic growth. Each situation is specific. What we have seen so far, also we have seen a little bit of contagion in the CDS or the rate market. At this stage, it remains quite well under control. Why? Because European governments are showing clearly a strong will to find a solution.
Well, today we're on the sidelines of the Europlace Financial Forum here in Paris. The delegates are discussing the rather large topic, the broad topic, the challenges faced by the financial sector. What are those challenges?
You know, I think there is certainly one major challenge. Financial markets are there first and foremost to link corporate and equity market to help refinancing. And certainly one challenge is that with the new regulation, Basel and Solvency, we have insurers which will have certainly more constraint to invest on the equity market, and it raises a lot of question marks for equity market development and for financing of the economy and of corporates. This is certainly one of the main challenges of this forum.
So lots to talk about. And one of the things you'll be speaking about specifically at this forum is where you see global oil prices heading. That's the subject that you are specifically focusing on. Yeah. What's your prognosis?
On oil, although we'll have certainly a lot of volatility, we see oil remaining a proper asset class. We consider that oil remain in the region of $90 to $110, and for the medium term, at the end of the day, remains certainly a safe investment. Why? Because it is a hedge against inflation. It is an edge against geopolitics. And if we have, as we think, the beginning of an economic recovery in the second half of the year in 2012, we see oil will benefit from this.
And what about the other famous hedge in times of uncertainty, gold? Where do you see that heading?
Gold remains, gold is the only asset where central banks do not require any collateral in front of gold. And frankly, gold, if I may say, is an alternative currency. And so longer we'll have a question mark either in Europe, on peripheral, or in the US with debt, it will remain certainly a very strong asset for portfolio. We need also to take into account that commodities, and gold is a commodity, prices are massively linked to dollar prices. We consider that the question mark and the issue with US debt are not finished. This is quite bearish for the dollar, and if we're right on the dollar, it will be positive for gold prices.
How about Asia? A slowdown there. There's concerns as well now about the state of local government finances in China that Moody's is flagging up. Where do you see things heading for the world's number 2 economy and its regional neighbors?
Tom, this is a very good question. We have had in China negative real interest rates for many years. It has created a bubble, point number one. And point number two, it has paved the way for strong inflation. Right now, the Chinese government tries to reduce this inflation by raising interest rates. But at the same time, this has two consequences. It slows down growth through higher interest rates. And the second part, it can potentially impact non-performing loans at banks. We have relatively few information about non-performing loans within Chinese banks, but it is likely that if we have higher interest rates, it will have a negative impact.
And how about Japan? Japan has obviously had different circumstances to the rest of the region in 2011. Do you see a second half really making an awful lot of catch-up for the first half, which was so unfortunately affected by the earthquake and tsunami?
Yeah, what happened on March 11 obviously was a terrible event. We are quite positive on a recovery of Japan for the second half of the year. Our key recommendation for Japan is that first, we are positive on Japanese equity. They trade now below book values. This is certainly a very interesting asset, both compared to other Asian equities and compared to worldwide equities, point number one. Point number two, we need also to raise a question mark of Japanese currency, yen. Also, we might have a technical rebound of the yen over the short term. The Japanese government will need and will have to refinance to find money to finance the reconstruction. It will be very difficult for them to come to the financial market because it will raise interest rates. Then one option might be quantitative easing. If they go for another round of quantitative easing, it will be very negative for their currency. Then we are quite cautious on the yen for the medium term. And obviously, this will be positive for the investment of US or European investors on the Japanese equity.
So a somewhat stronger second half for 2011.
Absolutely.
But let's move forward a little bit more. Could we have another lost decade ahead of us in Japan?
No, what is important for Japan? Japan has a GDP per habitant which is slightly higher than the one within the US. They had a very strong momentum in terms of GDP per head. The question mark is demography. This is the real issue, and this is indeed a very, very long-term serious problem. Short-term, Japanese equity will benefit from this economic recovery and reconstruction. Long-term, you're absolutely right, Tom, this is an issue.
Are there signs that lessons have been learned from all the events that have taken place in the last 3 years? Let's go back to 2008, crisis on Wall Street. Has anyone learned anything from all of those rather worrying situations where everyone found themselves in, particularly in the aftermath of the collapse of Lehman Brothers? Or do you think that Wall Street is back to its old tricks and it's as if 2008 never happened?
You know, I think the world has changed. Many regulations were put in place. Obviously, as I said previously, certainly the main question mark is to make sure, I would say, regulation doesn't go too far in terms of investing into equity for insurers, for funds, because this is the main question mark for the economy. In terms of regulation, I think many things have been addressed, many things have been announced by government and followed very, very, very precisely by banks.
So just to pin you down on the point of where you see the world heading, we're in uncharted territory. I listed a whole string of rather pessimistic observations about where the global economy is heading at the beginning of this interview, the indicators we're seeing. Yeah. What are you and your team at Société Générale seeing? Are we seeing double-dip recession on the horizon, or are we talking full recovery short to medium term?
We don't forecast any double-dip recession. All the indicators we have are showing that gradually there is an economic recovery in the US, in Europe. That's very slow, that's very mild, but it's there. Corporates are extremely safe. Gearing for European company in net debt ratios in the region of 30% for European companies, 25% for US company. What we see is gradually an improvement. The question mark for the world is certainly unemployment. We need certainly to keep in mind that the only US president who has been re-elected with an unemployment rate above 7% was Ronald Reagan in very specific circumstances. We are currently at 9.1. We think that it is very, very likely that we remain with very low interest rates at least for 18 months or 2 years in the US. This will be very, very positive. And the fact that in Europe we slightly raise interest rates protects against inflation, but will not be a barrier against growth. And we are relatively positive if we take corporates and if we take economic growth.
All right. I'm afraid we're out of time. Patrick Leglon, Head of Global Research at Société Générale, thank you very much indeed for talking to us. And thanks to you for watching. Do stay tuned to France 24.